Welcome back to our investing series. In today's video, we'll learn how to read an income statement, one of the most important tools in fundamental analysis. By the end of this video, you'll understand how companies make money, where they spend it, and how much profit they actually keep. An income statement, also known as a profit and loss statement, shows a company's financial performance over a period of time. It tells us how much money the company earned, how much it spent, and what's left as profit. First line you'll see is revenue, sometimes called sales or top line. This is the total money a company earns from selling its products or services. For example, if Apple sells iPhones worth $100 billion, that's its revenue. Next is cost of goods sold, COGS, or cost of revenue. This includes all direct costs like raw materials, labor, and manufacturing. When you subtract COGS from revenue, you get gross profit. Gross profit shows how efficiently a company produces its goods. To compare companies, investors use gross margin, which is gross profit as a percentage of revenue. Higher margins mean stronger pricing power. After gross profit, you'll see operating expenses, things like research and development, selling and marketing, and general administration. When you subtract these from gross profit, you get operating profit, also called EBIT. Finally, after interest and taxes, you reach net profit, also known as the bottom line. This is the money actually left for shareholders, net profit. Margin tells us what percentage of sales the company truly keeps as profit. By reading income statements, you can compare companies, track growth, and spot trends in profitability. Investors often look at revenue growth, operating margin, and net margin before deciding to invest. So that's how you read an income statement, from top line. Revenue to bottom line profit. In our next video, we'll cover the balance sheet and show how to analyze assets and liabilities. Don't forget to like, share, and subscribe for more investing guides.